The next chapter is chapter on taxation. This is a general chapter on taxation, general taxation in terms of, as covered in the syllabus. So I'll just take you very fast through it. Okay, so as defined in the income tax, income tax defines a person which is assessed to a tax, and therefore it can be an individual, HUF, company, firm, association of persons or body of individuals, local authority, or an artificial judicial person. So every person which can be classified into any of these categories is subject to tax, and basically the direct tax. Residential status of the person. This is one of the most important points in terms of defining or or determining which incomes will be taxed in the hands of that person, and therefore it is very important to define whether the person is a resident, non-resident, or a non-ordinary resident. Individuals in HUF can be defined into divided into 4 categories. First is the ordinary resident in India. This is basically people who are resident in India for more than 182 days in a year. Non-resident, which is the last category, are the people who are not resident in India for more than 182 days. Between the two, there are resident but not ordinary resident in India. So there are certain further qualifications or further definitions which will define whether the individual or an HUF is resident or a resident but not ordinary resident in India. This bifurcation is important because that will determine which incomes will be taxed in his hands. The last category is the deemed resident. This is a new category which was introduced from assessment year 2021-22, and the individual is and his residency is the individual's residency is determined on the basis of his citizenship, period of stay in India, and total income from Indian source. A company can be a resident or a non-resident. An Indian company which is registered under Companies Act 1956 is always resident, but a foreign company is resident only if the POEM in India, POEM means place of effective management. A firm, association of persons, or local authority, or artificial judicial person is resident if any part of the control and management of his affairs is situated in India during that year. Is a non-resident if the control and management of his affairs are situated wholly outside India during that year. The word wholly is very relevant because if any part is in India, then that will be treated as a resident person. The next point, as I discussed, was place of effective management. The place of effective management, as I discussed, is a place where key management and commercial decisions that are necessary for the conduct of the business as an entity as a whole are in substance made. So, which could mean if place of effective management can be in India, if substantially the whole management sits in India, or even if a board meeting of the director is held in India, because that will decide where the decisions are being made. Scope of total income. Why do we, as I said, why do we need to define between the three? So the different taxable income, different incomes which will be taxable will depend on the residential status. So if the income is received or deemed to be received in India, then it is taxable for residents, non-residents, as well as resident but not ordinary resident. If the income accrues or arises or deemed to arise in India, then also all the 3 categories are taxable. But if the income accrues or arises outside India and is derived from a business controlled in India or a profession set up in India, then only resident and non-resident but not ordinary resident are taxable. This kind of incomes, though received by a non-resident, will not be taxable in India. If income accrues or arises outside India for a business which is controlled in India, that income is taxable in the hands of the resident person, but not taxable in terms of non-resident and resident but not ordinary resident. So all incomes of residents are taxable in India, and only Indian incomes are taxable for a non-resident in India, whereas all outside incomes are not taxable in India. Taxation of various streams. This, as the income tax act has defined various income streams in terms of under which the incomes received will be taxable, and have various different exemptions and clauses, and even tax slabs or tax rates for all of them. So this is particularly related to investments and PMS investments, and therefore it is excluded salary or income from house property. It has only this has only included investments from income from investments as what are the nature of incomes there. So the first is income from dividends and shares, dividend on shares and income from units of mutual funds. The second one is income from interest on fixed income securities, which could be bonds, and even income from MF mutual fund bonds, debt mutual funds. Short-term or locked-in capital gain on sale of securities, which are shares, debentures, right realizations, sale of units, which are categorized under capital gains. Business income from purchase and sale of securities, if gains are categorized as business income. Particularly, more importantly, derivative income is included under the business income category. This is what we are talking about: capital gains. Capital gains. What is how does a capital gain arise? Capital gain arises on sale of a capital asset. What is a capital asset? If at the time of if the intention of the investor is to buy an asset for capital appreciation, it has. I mean, these are some of the illustrative reasons which can define an asset as a capital asset, and therefore subject to capital gains tax. There is a low transaction frequency in these assets. There is a long period of holding shown as investments in books of trade and not stock in trade. The difference here is very important, because if the investments are shown as stock in trade, then it has to be treated as a business income and not as a capital gains. It is use of own funds versus opposed to loan for acquisition. This is an illustration. So, it's not necessary that if you have taken a loan to acquire an asset, it will be only treated as business income. If you can satisfy the income tax officer, it can still be treated as a capital gains. Main object of constitution document is to make investments. So these are the illustrative cases which makes an asset a capital asset. Capital gains can be as are short term or long term. What is short term? Any asset which is held for less than 36 months is a short term asset. There are some exceptions. Assets held for 24 months, like unlisted shares, if they are held for more than 24 months, it becomes a long-term asset and not a short-term. Immovable property being land or building or both. Also, if they are held for more than 24 months, they become a long-term assets. In terms of other assets like listed shares of a company on a recognized stock exchange, that is equity shares or preferred shares. If the asset is held for more than 12 months, then it becomes a long-term asset. So though the short-term asset definition provides short-term as 36 months, these are the exceptions where unlisted shares and immovable property become long-term in 24 months, whereas listed shares of companies, listed securities like debentures, bonds, unit trust of India, units of equity-oriented mutual fund, zero coupon bonds, if they are held for more than 12 months, all become long-term assets after if you hold for more than 12 months. This is how short-term gains is calculated. So full value of consideration is the full sale proceeds that you receive on sale of asset. You reduce the expenditure which you have incurred wholly or exclusively in connection with the transfer. So if there is any expense related to that transfer, you can reduce that from your consideration. Cost of acquisition, cost of improvement, and exemptions under section 54B, So there are several exemptions which the Income Tax Act has provided, which you can claim as an exemption in a capital gain, capital gain income. So this, after reducing these expenses, you arrive at a short-term capital gain or loss, and then taxes payable on that. What is the tax to be payable? I will, we will discuss it in the next slide. On a long-term capital gain, the calculation is slightly different. So full value of consideration is the sale proceeds that you receive. Then you reduce the expenditure incurred in terms of in respect to the transfer. Then you then you reduce the index cost of acquisition. It's not the cost of acquisition, but the index cost of acquisition is what gets reduced in a long-term asset. long-term capital gain. You reduce the index cost of improvement, exemptions under section 54, which gives you the long-term capital gains. Indexation is nothing but, so index cost of acquisition is nothing but indexing the acquisition cost to the, to arrive at what would have been the current cost, for the to take into account the inflation. So this is how the index cost of acquisition is calculated. Cost of acquisition into the cost inflation index. Cost inflation index is declared every year by the government, by the income tax authorities, and therefore cost inflation index of the year in which the asset is transferred, divided by the cost inflation index of the year, cost inflation index of the year in which the asset was first held by the SSE, or or 2001 too, because that is the base which the cost indexation now starts with. No indexation benefit is available if it's a listed equity share, units of equity oriented mutual funds, or units of business trust, if the resultant capital is under capital gains. So capital gains, long-term capital indexation is benefit is available except for listed equity shares and equity oriented mutual funds, bonds or debenture except capital index bonds, which are issued by the government and sovereign gold bonds. Slump sale, in terms of slump sale of businesses, if it results in a capital gain, there is no indexation benefit available to the SSE. Units purchased in foreign currency by offshore funds, securities as referred to under 115AD purchased by FPIs or specified funds. This is particularly for specified funds. GDRs purchased in foreign currency, or unlisted securities referred under section 112 purchased by a non-resident. All this form an exception in terms of indexation benefit which is available to the SSE on long-term capital gain. Now coming to the tax rates, short-term capital gains on transfer of listed equity shares, listed shares sold through offer for sale, or equity-oriented mutual funds is taxable at 15% in the hands of whether it's a resident investor, non-resident investor, or FPI. This is what we deal on an everyday basis with all our investors, being either sellers of listed shares or mutual funds. Any other short-term capital gain, resident individual attracts a 30% tax rate. A non-resident investor, in case of LLPs and foreign corporates, also attract a 30% rate, but foreign companies which operate and have an asset sale in India would attract a 40% rate. FPIs also attract a 30% rate. In terms of long-term capital gains, in terms of shares which are listed on listed equity shares which are listed on recognized stock exchange and which STT is paid, the resident investor as well as the non-resident investor or even the FPI, they pay 10%, 10% tax on income in excess of 1 lakh. This is also applicable to units of sale of units of equity-oriented mutual funds. Long-term capital gains on sale of listed bonds or listed debentures is 10% without indexation for resident investors, 10% without indexation for all three categories. Long-term capital gains on transfer of unlisted bonds or unlisted debentures is 20% without indexation for resident investors, 10% for non-resident investors, and 10% and 10% for FPIs. Long-term capital gains on transfer of unlisted securities other than unlisted bonds and unlisted debentures is 20% with indexation for resident investors, non-resident investors, and FPIs. It's being taxed at 10%, and they don't have the indexation benefit. Therefore, it is important both in terms of in capital gains, particularly to identify what is the residential status of the SSE and whether it is short term or long term. Coming to the next income, which most of our investors and us receive in terms of dividend. Dividend can be dividend from companies or dividend from mutual funds. Dividend usually refers to the distribution of profits by a company to shareholders and distribution of its income by mutual funds to its unit holders. Apart from the dividend, which we generally believe or we generally accept, there are certain other distribution by companies also deemed as are termed as deemed dividend, and they are also to be treated like dividend. This is distribution to shareholders out of accumulated profits and reduction of capital by the company. Distribution made to shareholders of company on its liquidation from his out of his accumulated profits. Distribution of debentures, debenture stock or deposit certificates to shareholders out of accumulated profits of the company, and issue of bonus shares to preference shareholders out of accumulated profits. The distribution of accumulated profits to shareholding entailing release of company assets, or loan or advances made by closely held company to its shareholder out of accumulated profits. All this distribution is also termed as deemed dividend, and therefore it's treated as deemed dividend and to be taxed as a dividend in the hands of the SSC. Dividend and bonus stripping. Companies, investors take advantage of dividend and bonus in terms to reduce their tax liability by selling the original shares or selling the mutual funds or stock post dividend, and then claiming dividend which was an exempt income at certain point in time, claiming that as an exempt income. So the government, the income tax authorities have come out with certain regulation in this respect, which is to avoid dividend and bonus stripping. So, in both of the regulations, I think an SSE is required to hold these assets at least for 3 months before he can sell these assets and claim the benefits out of the dividend and bonus that accrues to it. Interest and business income. Interest income, as you know, are the income that arises from bonds, debentures, debenture stock, government securities, and therefore is treated as income from other sources and taxed accordingly. Business income particularly is profits and gains arising from any business and venture or business entity. In terms of investments, this point is valid because, as I said, the income which is derived from derivatives trading, or particularly options, futures and options, is treated as a business income. While computing, and therefore, while computing your income tax, it has to be included in business income. There has been a further clarification whereby it says that profits and gains of business or profession has to be divided into speculative and non-speculative. Taxation on derivatives, including commodity derivatives, which are done on a recognized stock exchange, are not considered as speculative. But if it's done on an unrecognized stock exchange or on any other platform, those are treated as speculative transactions and therefore treated as speculative business income. Double taxation avoidance agreement DTA. The government has signed double taxation avoidance agreement with many countries, and therefore investors who come from this jurisdiction or these geographies can take benefit of the double taxation avoidance agreement and avoid taxes in India and pay taxes in respective countries. Relevant examples are Mauritius, Singapore, Dubai, Cayman Islands, and such other countries which are tax havens for the investors. The last point on this taxation bit is Section 9A of the Income Tax Act. This has been a new section which was introduced last year, whereby this provides a special taxation regime for respect of certain offshore funds in context of the fund managers being located in India. So this has several exemptions to enable fund managers who are sitting outside India's jurisdiction to come and settle in India and open their shops in India, and they'll continue to enjoy those tax benefits which they were with the foreign investors were enjoying before when the fund managers were sitting in those respective foreign jurisdictions.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.